we see this year as a bit of a turnaround year, actually. 2025. 24 was a very, very tough year, and at the end of 24, we guided to the market that we still felt 25 was going to be challenging. I think the guidance then was -2 to 5%, but at the half year we saw things improving, and we changed that guidance and outlook from negative to positive 1 to 3. We tightened that guidance to 2 to 3 at the pre-close, and we've actually now surpassed that 3, albeit very sort of notionally, with a 3.1% increase in distributable income per share. We think the property cycle has bottomed out and we've turned, and we think that this property sector is poised for some growth. If you look at our key metrics across, especially the South African business, which is still 50% of the business, they are looking pretty healthy. Loan to value, we brought that right down. The absolute level of debt is now in South Africa 38 billion from over 40 billion. If we look at our interest cover ratios, they've improved. So all the metrics have improved, and off the back of that, I guess we've got the confidence to pay out a higher payout ratio. You may recall the last couple of years, SA has been pretty negative and not really contributing, and you can see the improvement there with the 3% growth in distributable income is about 151 million rand. And we've got 5 or 6 or 7 elements there that contributed to that. The biggest contributor by far was the South African portfolio, and notwithstanding some disposals, we've actually grown. The South African contribution has grown by 236 million, and that is across the board, though. I mean, better performance, retail, office, industrial, as Estienne said, he'll show you the numbers later, office in particular. If you analyze the numbers in detail, in fact, a very big portion of it coming from better cost management and better recoveries of, let's say, some of our utilities, improved recoveries on electricity, improved recoveries of all the different outgoings. So South Africa performed particularly well. I think like net property income growth almost 6%, just 5.9% for across all 3 sectors.
Our finance cost reduced marginally. The LTV on the SA balance sheet. So just to understand, when we talk about our LTV for the group, that's reduced from 42.3 to 40.1. It takes all the consolidated GOZ and equity accounted investments into account, as well as all the funds. Whereas when we look at this balance sheet for South Africa, it is sort of the pure South African entity, and there we've made good progress in reducing the finance to actually a very, very conservative level now. And whilst the LTV sort of has the valuations in it, when you look at the interest cover ratio at 2.9 for the South African balance sheet, that speaks of a very conservatively financed business. We've seen this year also, for the first time, all 3 sectors improved valuation growth there of 1.4 billion rand, which is starting to indicate that things are improving, and even the conservative valuation fraternity think the same. Our developments for the period, we continue to invest in the portfolio at 1.6 billion, and we've got commitments of a further 1.2. So actively disposing, at the same time we're reinvesting into newer developments. Over the years, we've actually quite significantly transformed this portfolio.
We're feeling a lot more confident. We feel the property cycle is, has bottomed out and is turning. SA is doing better. Our liquidity and balance sheet looking good. The international investments are pretty solid and will continue to contribute, going forward. V&A, in fact, we talk about the V&A potentially delivering double-digit growth next year.